computer. Okay, hello everybody. Thank you for making time with me here in this class, 319. If I'm not mistaken, I mean, there has been so much time. I'm confused with everything, like classes, days. Anyways, okay. So in this class, we will be talking about some uncertain case, which is the basis for investments. So let's start with the definition of investment risk. Investment risk is kind of related or associated with the probability of having a loss. So, so the greater the chance of lower than expected or negative returns, the greater the risk. That's kind of like the basis for definition. So in finance, we have two kinds of data, guys. So we have, before like studying this class, we have to make sure that you understand these two data. The first one is called realized data. Second one is called probabilistic data. Realized data is the data that happened in the past. Okay, so this is past. Probabilistic data is kind of, you don't know it, so this is past. So this is kind of future. Okay, probabilistic data is what's going to happen in the future. So that's called probabilistic data. Well, let me show you an example of realized data. So say we have returns of Bank of America and Apple. To the left, you see Bank of America. To the right, you see Apple. And this is 1 year data from March 2016 to 2017. And you have all the descriptive statistics. So what average return of Bank of America, average return of Apple, standard errors, median, standard deviation, everything. So this is called realized data. It happened, you observe it, you invested in it, and you see all the numbers. Okay, so here is the blue one, once again, is Apple, and the red one is going to be Bank of America. So when you draw the histogram, this is going to be the histogram of Apple that I showed you a moment ago, and this is the histogram of Bank of America. So the red one is Bank of America. Okay, you see the numbers. I mean, let me like shortly explain you. So whose mean is higher? Do you see the means, guys? I mean, looking at the chart or looking at descriptive statistics, who has higher mean?
Bank of America, yeah.
Thank you, Joe. Yes. And who has higher standard deviation?
Bank of America.
Oh, thank you, Austin. Welcome back, by the way.
Thank you.
Are you Austin De La Rosa or Austin
Yeah,
Carson?
Austin De La Rosa.
Oh, okay. Thank you. Just to make sure who is here. So yes, Joe and Austin are right. So Bank of America has higher mean. Look at this number here versus that number here. Okay. Plus, Bank of America has a higher standard deviation, 1.72 versus 1.25. This is mostly the case. I mean, whoever has higher mean, in general, okay, mostly there's no rule. I mean, there has been tons of exceptions, but mostly higher returns are always, not always, are mostly associated with higher standard deviation. And we use standard deviation as a kind of proxy for risk. So in order to, maybe let me shortly summarize what's going on in this graph. In order to get a higher return, you have to bear a higher risk. Okay, so that's the bottom line of this graph. This happened in the history. Okay, so this is called a realized data. So a couple of like selected realized returns in the history. Look at those numbers, please. Small stock companies between 1926 to 2013, their average return was 16.9. Large company stocks, long-term corporate bonds, long-term government bonds, and US Treasury bills. These are their returns, okay? Who has the highest return here in this graph, in this table, once again?
Small company stocks.
Thank you, author. Who has the highest standard deviation?
Small company again.
Thank you, Austin. They are both right, okay? So that's again the same thing. Who has the highest return is mostly associated with higher standard deviation. Okay, standard deviation, once again, is kind of associated with risk. So if we are talking about risk, you mostly use standard deviation as a proxy. Okay, standard deviation is the deviation from mean, okay, in statistics. So it's generally the case. I mean, if you want to get higher returns, you have to pay a higher risk. Okay, if you want to get a lower risk, a guaranteed risk, it will have a like very low return. I'm sorry, very low risk. Okay, that's most of the case. These are once again realized data which happened in the past. We are not still talking about future. Now, the second data is called probabilistic data. As I told you a moment ago, this is about the future. Okay, so the future data. So you don't know the data, you don't observe anything, you are just like guessing. Okay, you see that with like, I don't know, 15% probability it's going to rain. If 85% probability it's not going to rain, and then you invest accordingly. Okay, so this graph, the graph you see here is called the histogram or probability distribution. Okay, and mostly this is called expected rate of return, which I will explain in a moment. And then the distribution of this graph, look at the blue graph, it's kind of more focused in the mean, in the center, but the red one is kind of more distributed. Do you see that, guys? The red one is more distributed. Okay, let's go back to Apple and let me illustrate my point once again. Maybe you would understand better. So let's go back to Apple and Bank of America. Bank of America it has a higher return and higher standard deviation. Okay, and Apple, lower return, lower standard deviation. Look at Bank of America once again. I said higher standard deviation generally means higher distributed graph. Okay, this graph, the red graph, is distributed to the tails. You see that it's kind of like deviated from mean more than the blue one does. Okay, the blue one is kind of centered or focused at the center, but the red one is kind of like distributed. It has tails here and here, which means that if you invest in Bank of America, you have a higher chance of losing, but you have a higher chance of gaining really good returns. But if you invested in Apple, the highest you will get is kind of somewhere here, and minimum is somewhere here. Okay, that's more or less about mean and standard deviation. Okay, so let's define what's expected return. Well, if we are talking about probabilistic data, there is no average because then nothing happened. Okay, if we had a realized data, we have an average. So you observe the returns, you can just like add the returns, divide it by number of things, and you can get the mean. Okay, but if you are talking about probabilistic data, there is no mean because there is no data. Okay, but there is something called expected return. So with some probabilities, you have corresponding returns. We have some other probabilities, you have some other returns. Okay. So say, here's an example. So there are two stocks here. The first one is called StarSense. Second one is called JPOT. Okay. So there is some probability of recession and some probability of boom. Okay. Think about like the future. So we are having a coronavirus problem these days. Everybody is expecting a recession. And we say that there's 50% of recession probability. There's 50% of boom probability. Say, this is an example. Okay. And then if recession happens, StarSense is going to give you negative 20% return. This is your expectation. These numbers are totally made up numbers, your expectations and your, let me say, your guesses, okay? So you guess that if there's a boom, StarSense is going to give you 70%. If there's a recession, it's negative 20%. For JPOT, it's a different company, okay? So for JPOT, if there's a boom, your return is going to be 10%. If there is a recession, your return is going to be 20%. Okay. So these are, did those numbers happen? Did they realize, or were they realized, guys? Did I observe this 30%? Did I observe this 10%?
Well, I mean, if you sold it, you realized it.
No, well, let me clarify my question. So did the recession happen? We are talking about next year.
No.
No, it did not happen. Okay. Once again, if you are talking about probabilistic data, okay, probabilistic data, we are talking about future and nothing realized. Okay, nothing realized. I mean, nothing happened. So this is a totally made up chart. Okay, if you're talking about probabilities, okay, think about Apple. I mean, say you want to invest in Apple. Do you know what you are going to get at the end of this and at the end of 2020? Do you know it?
No, you can only guess.
No, you can only guess, okay? You can't know it. But the history might be a good proxy. That's something else. I mean, you might guess looking at the history or looking at the future, whatever, but you don't know it, okay? It's nothing is realized, okay? So let's go back to previous graph, a previous slide once again. So if nothing is realized, we don't have mean, okay? So if something is realized, let me just write here. If realized data, there's realized data, we are talking about mean. If we are talking about probabilistic data, we are talking about expected return. And expected return is defined like this. Every single probability is going to be multiplied by corresponding returns, and you add those numbers. Okay, let me write this down. First probability times first return plus second probability times second return plus third probability times third return, etc. It goes all the way at the end. I mean, how many probabilities you have, okay? Depending on how many probabilities you have. In my example, there are only two probabilities, okay? Like there's a probability of boom and there's a probability of recession, okay? So how to calculate the expected return of StarSense? First probability times first outcome, second probability times second outcome, okay? First probability is 50% times first outcome. Second probability, so this is P1, this is R1, this is P2 plus, this is P2, this is R2. You add those numbers up and you get 25%. So 25% is your expected return from StarSense. So if you invest in StarSense, you are kind of expecting 25% return in the future. So this is your expectation. I mean, Arthur's expectation might be different than Joe's expectation. Joe's expectation might be different than, I don't know, Maria's expectation or Austin's expectation. Did you understand this calculation, guys?
Yes.
Yes.
First probability times first outcome, second probability times second outcome. Now let's look at JPOT, okay? First probability times first outcome, second probability times second outcome, okay? So 50% times 30%. So this is P1, by the way. This is R1. And plus, this is P2 times, this is R2, okay? You add those numbers up and you get 20%. Kind of, so you are expecting 25% from StarSense, you're expecting 20% from JPOT. That's the bottom line if you have a probabilistic data. So this is called expected returns. So you multiply probabilities with the corresponding returns. Do you have any questions up to here?
No.
Any questions, guys? Let me pause for a moment and then wait your questions. Let me see the chat window if anybody has any question. Okay, it seems that. Hannah, do you have a question?
No.
Zach? Zach can't talk, so he's writing in the chat, I think. Nope, okay. Vemid? Okay, so let's continue defining a couple of other vocabulary. So we defined expected return. We are going to now define something called expected risk premium. Okay, so it's expected return minus the risk-free rate. Risk-free rate is mostly the interest rates you receive from government bonds, okay? So it's called risk-free because it's US government, and then there is no uncertainty about that, you are going to get that anyhow, okay? So that's called risk-free. If somebody is risk-averse, if you hate risk, buy a US Treasury bond, and then you will get 1 or 2% return for sure. It's risk-free, okay? There is no risk, but there is no return, okay? The return is very low, okay, since the risk is very low, okay? Remember our first discussion in the beginning of the class? If you are seeking for a high return, you should kind of bear high risk, okay? So risk-free rate is mostly the interest rate in government bonds. So expected risk premium is your expected return minus risk-free rate. In this exercise, for example, Star Sands was 25%, and it says risk-free investment is 8%. So minus 8% will give you expected risk premium, which is 17% for Star Sands. So this is Star Sands. For JPOT, it's going to be what minus what? Okay, here's a bonus question. Who wants to do this? JPOT. What is the expected risk premium for JPOT? JPOT. Expected risk premium. Very easy. Just the same exercise. What minus what? What is the expected risk premium of JPOT?
12% minus 8%, which is 4%.
Very close. Just don't forget that the expected return of JPOT is not 12%.
Oh, 17%. Oh.
No, just go back to previous slide, which I skipped now. Don't look at. Probably you are just looking at those blue
Yeah, that's
number
what I'm
here.
looking at. Yeah.
Please ignore that. It's the answer.
Oh, okay. So
Cheating is allowed, but be careful.
would it be 20% minus 8%?
Exactly, 20%. That's what we calculated at the previous slide. Minus 8%, it gives you 12%. Okay, so 17% is the expected risk premium of Star Sands. 12% is the expected risk premium of JPOT. Okay, the bottom line is this. Maybe I should summarize the things. So say Star Sands once again. So also it was you, right?
Yeah, that was me.
Okay, Star Sands and JPOT once again. So we calculated that Star Sands expected return was 25%. JPOT's expected return was 20%. So we did this a moment ago, okay, in the previous slide. And it now says that a risk-free rate is 8% for both. Now I can calculate the expected risk premium. Expected risk premium. So 25% minus 8%, you get 17% here. 20% minus 8%, you get 12% here. So why did we call this expected premium? What does it mean? Okay, we called expected risk premium just because if you invest in government bonds, you are going to get this 8% anyhow. Okay, so JPOT is kind of like paying you 12% on top of the government bonds. So it's kind of the premium you get in return for the risk you are taking to buy a JPOT. Okay, it's called expected risk premium on top of the government bonds if you want to buy JPOT. But Star Sands kind of pays you more, okay? So if you invest in Star Sands, you are going to get 17% on top of the government bond, okay? So bottom line is this: if you invest in government bonds, you will receive 8%. If you invest in JPOTs, you are expecting to get 17%. If you invest in Star Sands, you are expecting to receive 25%. So that's the bottom line. And these are the corresponding expected risk premiums, okay? Okay, any questions here?
Are dividends calculated in any of this?
Good question. They're all included in those numbers here that we show you. So they're all
Or we're just talking about like price appreciation and that's it?
Well, any kind of appreciation is added here. So it's like, I don't give you the details. I just tell you that if you invest in Star Sands, there are two options. You'll either get 70% dividends included, or you'll get negative 20% dividends included. Okay.
All right.
Okay, now let's go back to our Apple and Bank of America once again. Remember, if you have mean, you have corresponding standard deviation, which is risk. Okay, so this is kind of what you had on average in the past, and this is the risk you bear. Okay, that's the same thing. So this was realized data. Okay, that's the same thing for probabilistic data. So what we calculated, expected return, is kind of the other name for mean. Okay, mean is used for realized data, expected return is used for probabilistic data, and that there's standard deviation for realized data, and there's standard deviation, which has the same name, for probabilistic data. So yeah, that's how it is. Maybe I should just put a chart here once again, just to make the things. So realized data, probabilistic data. So guys, I'm sorry that I need to use these like the little empty spots in the slides to explain the things. Since this video is recorded, you can just like pause it and then take a look at my notes from the video. So I can't keep them, I need to kind of erase them. So if you have realized data, okay, so you have mean. If you have a probabilistic data, so you have expected return. If you have realized data, you have standard deviation. If you have probabilistic data, you have standard deviation too. So the names are the same. Now, let's look at the probabilistic data's standard deviation formula, which is kind of like a little ugly. But for the moment, I'm not going to go into the detail of this formula. I showed you how to calculate the expected return. Please make sure that you understand the expected return. The variance is a little complicated. Please take a look at that one, but I'm not going to go deep into the detail of the formula, but just understand that we can calculate standard deviation for probabilistic data too. The other thing is called variance, as always. So we had variance. So mean is associated with expected return, standard deviation is associated with standard deviation, and variance is associated with variance. Okay, it's the same thing. Okay, so this is realized data, this is probabilistic data. And variance is always a square of standard deviation, okay? Or standard deviation is simply the square root of variance. So I'm not going to show you how to use this formula, and I'm not asking you to learn the details, but I'm asking you to understand what standard deviation is for, okay? Which I will show in a moment. So we need to calculate, remember star sense and JPOT once again. Star sense having a higher expected return does not mean that you should invest in star sense, okay? The question is why? If somebody has a higher expected return, should I invest in it, invest in it? Or there are other things that I need to take a look at?
Shouldn't you also look at risk?
Thank you, author. That's right. And risk is associated with what?
Standard deviation.
Standard deviation. Okay. So you should always look at the risk, which is associated with standard deviation. And the standard deviation is shown in this formula. But as I said, I'm skipping it. And please make sure that you understand the idea of standard deviation. Okay, somehow, and as I said, I skipped the details. Somehow we calculate the standard deviation, which is 45% for star sense and 10% for JPOT. Remember the expected return, we calculate 25% and 20% respectively. So star sense has a higher expected return. Remember Bank of America, just an analogy, Bank of America, in our example, has a higher mean and higher standard deviation, okay? And Apple has a lower mean and lower standard deviation. It's the same thing. Star sense has a higher expected return and higher risk, okay? JPOT has a lower expected return and lower risk, okay? So just somehow, as I said, I'm skipping the details, but understand that this higher standard deviation means that star sense is risky investment, okay? So that's the bottom line. So how can we kind of like combine those two numbers. Okay, expected return, that's something that you have to know, and standard deviation, that's something you have to know too. There's variance here, but it's not something interesting. It's just the square of standard deviation. So whatever this number is, when you square it, you will get this number. Okay, so just square it. So standard deviation is not too different from standard deviation. They are the same thing. Okay. Once again, standard deviation measures total or standalone risk if you are talking about one single investment. So you have to take a look at standard deviation. Okay. So the larger standard deviation, the larger the sigma, or standard sigma is the sigma stands for standard deviation. The lower the probability that actual returns will be close to expected returns. Okay, the larger sigma is associated with a wider probability of distribution of returns, which means risk once again. Okay, so how can we, this question still is there, how can we combine those two things? So if I know the standard deviation, if I know the expected value, how can I compare those two numbers? And that's called coefficient of variation. Okay, coefficient of variation is risk, which is standard deviation, divided by expected return. Whatever the risk is, just divided by the expected return. Or if this is probabilistic data, if it is realized data, standard deviation divided by what? Just guess. Bonus question. If it is realized data, I divide standard deviation by what?
The actual return.
Actual which return? You are close.
Realized return.
The data is realized. So assume that this is Bank of America. I'm going to divide standard deviation of Bank of America to what?
Return of Bank of America.
Which return? I mean, they are like 12 or
Average return.
average return. That's what I'm saying. So it's called mean. Walter, was it you?
Yeah.
Okay, thank you. You get the bonus. Mean or average return. Okay, that's the same thing. If it's probabilistic data, standard deviation divided by expected return. If it is realized data, standard deviation divided by mean. Okay. Now let's go back to Apple. Coefficient of variation of Apple is 1.2% divided by, which is standard deviation of Apple. This is the average of Apple. Okay. Now I'm asking you to calculate the coefficient of variation of Bank of America. Everybody do it, please. Probably you need the chart. So calculate the coefficient of variation for Apple. Oh, which one? I'm sorry, Bank of America. Do it, please, and tell me the answer.
Is this for realized?
Yeah, just whatever you see in the screen.
Okay.
Zach says it's 6.3.
That's what I got.
Okay, most probably you're right. So Zach, you get a bonus too. Okay, so let's see how you Zach, can you please tell us how you did it? You divide what to what? $1.72 divided by 0.27, which is right. Thank you. So it's exactly the same thing here. Okay, Bank of America coefficient of it, the CV does not stand for curriculum vitae. Okay, it's not so real, your resume. So Bank of America, it is standard deviation of Bank of America, which was 1.72 divided by 0.27, and you get 6.37. Okay, so the question is, which one should I invest? Okay, if I care only about average or risk and expected return. It turns out that let's analyze the intuition of coefficient of variation. Coefficient of variation is standard deviation, okay, normalized by return, okay. So you want the standard deviation as low as possible. You want the expected return as high as possible. So this number should be, it's better to, this number is going to be as low as possible. So risk should be as low as possible. Return should be as high as possible. So when you divide them both, so the lower coefficient of variation, the better. Okay. So once again, Bank of America's CV is 6.37. So the Bank of America has lower coefficient of variation than Apple. Then if you care about risk and expected return, so you should invest in Bank of America, even though it has a higher return. Okay, let's remember the higher standard deviation. I'm sorry, standard deviation and mean. Okay, well, 1.7 divided by 0.27. So even though the risk of Bank of America is higher than the risk of Apple, when you normalize it by the mean, you get a higher number. Okay, just because you just like look at the mean of Apple, it's 0.14. You just double the mean in Bank of America and increase the risk a little. So you don't double the risk, but you double the return. So somehow that's why Bank of America, you just like increase the risk a little and you double your return. That's why Bank of America is makes more sense to invest. So the bottom line is this. So if you are like looking at single stocks, if you are comparing single stocks, you take a look at standard deviation, you take a look at the expected return, and you divide those numbers into each other, and then you get one number which is called coefficient of variation. So coefficient of variation, the lower, the better. The lower, the better. Any questions? So up to here, I talked about single stocks. So Apple versus Bank of America, StarSense versus JPOT. But in reality, we have a portfolio. Okay, people do not invest in single stocks. People invest in a variety of stocks, like 5 stocks, 6 stocks at the same time, or maybe 2 stocks at the same time. So how can you calculate the expected return of a portfolio? How can you calculate the risk of a portfolio? So if you have more than 1 stocks, okay. So first of all, portfolio is a group of assets, okay, like stocks, bonds, T-bills, options, futures, etc., that are held by investors, okay? So if you have a portfolio, you have more than 1 asset. So let's first define what's expected return for the portfolio. So if you know the expected return of individual stocks, so first of all, you need to know the expected return on individual stocks. Say, remember, once again, StarSense was expected return of StarSense was 25%. This is a very terrible 5, but this is 5. Sorry. JPOT, expected return of JPOT is 20%. So first of all, you need the expected return on individual stock. Assume now that I'm going to combine those 2 stocks in a portfolio. So I'm going to invest some in StarSense and some in JPOT. So the question is, what will the expected return of my portfolio? Well, the answer depends on the weight. How much you invest in StarSense, how much you invest in JPOT. So the higher the weight of StarSense, the higher the closer the return of your portfolio to StarSense. Okay, say if you invest 100% in StarSense, the expected return of your portfolio is going to be 25%. So let me draw a line here just to illustrate my point. Assume that your 1 stock is 25% here, expected return. Your other stock here is 20% here. Okay. So the return of your portfolio is going to be somewhere in between. Okay. If you invest heavily in this stock, StarSense, your portfolio return will be closer to that point, somewhere here. If you invest heavily in, this is JPOT, by the way, StarSense. So if you invest all of your money in JPOT, your return is going to be here. If you invest all of your money here, all of your money is StarSense, your money is going to be, your expected return of portfolio is going to be there. If you equally divide your money into 2 stocks, then your expected return is going to be in the middle. So if 50-50, so your return is going to be here. If it is 60% StarSense and 40% in JPOT, so your return is going to be somewhere here closer to StarSense. Well, anyhow, there's a formula for all of this mess. So first weight times first expected return. Remember, probably it's very similar. First weight times first expected return. So I'm just explaining this formula here. Second weight times second expected return. And if you have 3, then you're going to add that, okay? Well, so let's do an example. Let's give you an example. So what would be the, so remember star sense and JPOT once again. What would be the expected return portfolio? Equally weighted portfolio. Well, equally weighted meaning 50%, 50%. So first weight, Starbucks weight, so star sense weight, I'm sorry, star sense weight multiplied by star sense expected return plus JPOT's weight times JPOT's return. Okay, so you get something exactly in the middle. So remember, it was 20%, 25%. Now you get something exactly in the middle. All right, let me pause you for a moment. Any questions, guys? Are you following me? Well, everybody is lost, I think. I can't see anybody. Let me close my camera too. Nobody shows himself or herself. Guys, you can just respond me, please. Say either yes, no, or undecided. Either open your microphone, camera, or chat, guys.
I'm following.
One of those, please.
I'm not sure yet.
You're not what?
I feel like I'm starting to get it. Could you do like maybe another example or go
Sure.
over this?
Okay, sure. Good question. Thank you. Okay, now let's do this exercise. Assume that the weight of star sense, I'm going to say star sense here, so this stands for star sense. I'm going to spend 60% of my money. Well, weight meaning your money invested in that stock divided by total money. So 60% of my money is going to be invested in star sense, and 40% of my money is going to be invested in JPOT. So this is JPOT. So my question is, calculate expected return of our portfolio. Okay, just do that. Use your like pencils, pens, whatever, and do a math and let me know how it goes. So weight meaning, for example, you have $100. If you invest $60 in star sense and $40 in JPOT, this means the weight of star sense is going to be 60 divided by 100, which makes 60%. Weight of JPOT is going to be $40 divided by 100, that's 40%. So weight meaning how much money you invested in that stock. And if it is 60% in star sense and 40% in JPOT, so this is JPOT, okay? My question is, what would be the expected return on my portfolio? Do some little math. Maria says it's 36%. Well, it can't be, Maria, just because it has to be between 20 and 25. Okay, so you are making a mistake. I don't know the answer, by the way. Zach says 23%. Zach, can you please write it down how you did it on the chat screen? Okay, exactly. Author, please follow me now. Remember the formula, first weight times first expected return plus second weight times second expected return. Okay, the first, say the first one is star sense, I'm sorry. Star sense weight is what? Author, I'm asking you. Star Sense weight is what?
Star Sense weight. Would that be 25, right?
No, weight. How much money I
Oh,
devote
wait.
to?
So 60.
Okay, 60%. Okay, let's say 0.60 times its expected return, which was 25%. Okay.
Okay.
And then how about JPOT's weight?
40.
40%, 0.4 times JPOT's expected return, which was 20%.
Yeah. Okay. Okay.
So this makes 8%. This makes 15%, I think. And then you add those numbers up, it makes 23%.
Yeah, that's right.
You are close. It should be 23. Did you see my calculation, Hannah? Oh, okay.
Okay, that makes sense now.
So weight, once again, meaning it's not probability. Weight is how much money you invest in Star Sense. Or let me just I show you one more example. So now I'm not going to give you weights. You are going to calculate the weights, okay? Say I have $500. Now, this is my total money. And then I divided money into two, okay? I bought $100 worth of Star Sense and $400 worth of JPOT. These numbers are still valid. So my question is, so this is my portfolio. Okay, my portfolio consists of two stocks. My question is now, what is the, oh, I'm sorry. Okay, my question is, once again, what is the expected return of my portfolio? Now you are supposed to calculate the weight of Star Sense yourself. You are not given. You have to calculate the weight of JPOT yourself. Okay, who can tell me the weight of Star Sense?
20%.
20%, right. How did you get it?
It's just 100 divided by 500.
Exactly, 100 divided by 500. So it makes 20%. Okay, so 100 divided by 500, it will give you 0.2. Okay, how about JPOT?
80%.
80%. So the remaining should be so 400 divided by 500, or 1 minus. So 1 minus 20%, it will give you 80%. Okay, so expected return on my portfolio is going to be Star Sense weight, which is 20%, times Star Sense expected return, which is 25%. Okay, plus 80% times 20%. Did you get this? So this makes 16%. This makes, I think, 5% probably. So when you add those numbers up, it will give you 21%.
That's what I got.
Now, as you see, I invested heavily in JPOT, so my return is very close to 20%. Remember, this was JPOT here, 20%. This is JPOT. This is JPOT. This is 25%. This is Star Sense. So my portfolio's return is very close to this one, just because I invested heavily in JPOT. Okay, it should be very close to JPOT. Okay, Maria, Zach, Hannah, Sarah, whoever, are you more clear now? Are things clearer now?
I get it now, yeah.
Sarah says yes. Vemi says yes. Okay, I'm cleaning this. By the way, I mean, this is the expected return of the portfolio. Now, there's another thing called variance or standard deviation. The question is, what is the standard deviation of this portfolio? Okay, it's even uglier. Okay, so the formula is even uglier. But there is a formula. Okay, so just keep that in mind. Okay, let's do this exercise, one last exercise. Maybe I can skip this exercise. You can do it on your own. It's very easy. The same numbers, like the same formula. Now I have expected return 2%, 10%, and the weights are 50-50. So it has to be something exactly in the middle. Please take a look at this example after the class, after I'm done. Okay, now there's a very ugly formula which I won't ask you to memorize or write it somewhere, just to get the idea. So there is a formula. So this is the first asset weight, first asset standard deviation, second asset weight, second asset standard deviation, first asset weight, second asset weight. And now there's something weird here called correlation. Okay, first asset standard deviation, second asset standard deviation. Okay, forget about the formula. Just keep in mind that there's a formula which calculates the portfolio's standard deviation. So please log into your Canvas accounts and download an Excel sheet called Efficient Frontier. So do you have your laptops with you guys?
Yes.
Okay, please just download that Excel sheet from this week. And then in the first sheet, it says portfolio returns, and open this Excel sheet. And we'll do some math. Well, some Excel, not math. Okay, please let me know if you open it, guys.
All right, I got mine up.
Okay, so we have two stocks here. It's okay, so let me ask you a question. Is this a realized data? Is this a probabilistic data?
This is realized, right?
Right. How did you decide that?
I just looked, that said historical returns and assumed
It
that it
says
was.
like 2005, 2006.
Yeah.
So these are, it has to be realized data. Okay. So there are a couple of questions at the bottom. It says calculate the portfolio returns for each year using the weight in cell G4. Okay. In cell G4, it says the IBM's return, IBM's weight must be 50%. Now, just in the third column, which is the yellow column, just click on D5. Okay, so if I invested equally in IBM and Walmart in 2005, okay, so what would be my portfolio's return? Well, use this weight, so IBM's weight, which is G4, times IBM's return. Okay, first weight times first return. Remember the formula: first weight times first return plus second weight times second return. What should be the second weight now? So what should be the weights of Walmart? If I invested 50% in IBM, what should be the weight of Walmart?
50%, right?
Exactly. So 1 minus IBM's weight. Okay. I'm not going to write 50%. I'm going to use the cell just because if you change the cell, everything would change. Okay. That would be good. Times Walmart return, right? Here, let's do a little trick. Click using your mouse, click on G4, you bring your cursor in between G4 and hit F4 cell, and here too, okay, F4 cell. F4 is going to put the dollar sign in front of G and 4, which means that you kind of lock it. Okay, I'm going to drag and drop. I won't want that to change. Okay, so did you get this number? Exactly the same number.
Could you show us how to do that shortcut again with F4? I don't think I was able to do it.
Just a second. Here you go. Do you see it?
Yeah, got it. Nice.
F4 is the shortcut. Okay, so did you get the same exact number, guys? I would really appreciate if you respond me, guys. Since
Yeah, I
this is
got
not
it.
a class,
Yeah, I got it.
mean, I don't know who does
Yeah,
what.
I got it.
Okay, thank you. I mean, if you don't get it, that's still fine. Just tell me that you don't get it. If you don't respond, I'm not sure if you hear me. Okay, so this is for 2005. Just like bring your cursor at the on top of this tiny little square here at the bottom right and double click on it or drag and drop. Please delete those two cells here. They're not a year. Okay, until 2014. Did you get the same exact numbers? Same exact. It has not. It should not be closed. It must be.
I got the same answer that you have for the first cell, but somehow the rest of them are not the same number.
Just because you didn't put $sign, most probably. Did you hit F4 sign?
I couldn't figure out how to do that.
Okay, so
I thought
do you have these $signs here?
no.
Okay, just put it then. Either you can put it one by one, or you can bring your cursor on G4 and hit F4 button. Okay, Wenbin, Sarah, who else? Zach, Austin,
Yep, I got all the numbers.
Author.
I got him too.
Okay, so this is going to be my portfolio return. So if I invest in IBM and Walmart at the same time, these are going to be my portfolio returns. Okay, so now these are portfolio returns. Now let's calculate the average. Okay, so right here, average, and open the parenthesis. Okay, right here, in capital the average, and select IBM, and hit enter. You would have IBM's return here. Just drag it to the right. You will have IBM return, Walmart return, and your portfolio return. It must be exactly the same, guys, not close.
Yep, I got those numbers.
Thank you, Austin. Who did not? Joe, Wenbin, Hannah, Maria. Okay, can you comment on what we are doing here? So what does this 24.82% mean? What does it mean? I mean, getting numbers are okay, but what does it mean? Okay, let me ask you an easier question then. What does this 8.96% mean? What does this number mean? I mean, how can you interpret that?
It's the average historical returns from year 2005 to 2014.
For which company?
For IBM.
Thank you. Hannah, is due?
Yeah.
Oh, thank you. Exactly. So this is going to be my average return between 2005 and 2014 for IBM. Okay. And this is going to be Walmart. As you see, Walmart is far higher than IBM. Okay. And this is going to be, as Zach says, 24% is average return of what? IBM or Walmart?
Both.
Both. The portfolio, exactly. Okay, so this is going to be my portfolio's return. Okay, so let's see. So let's calculate standard deviation for both. Okay, so right here, standard deviation. So that's why I don't want to show you the formula. Excel does this anyhow. Right here, STDEV, and now select IBM. Okay. And now drag it to the right.
Oh, okay.
Did you get the same numbers?
For portfolio return, I got 38.6.
Let's see what others get. Maybe I'm making a mistake. I don't know. Let's see. No, I don't think so.
I got 24.26 as well.
Yeah, that's what I got.
Okay, author, can you please check your formula here? Like look at the formula I'm showing you right now.
Yeah.
It's standard deviation from D5 to D14.
Oh, I see the problem. I see the problem. Yeah.
Okay.
Okay, fixed it.
Okay, so let's review what we have done up to now. So this is IBM's return, average return. This is Walmart's average return. This is my portfolio's average return. And remember, this is equal weighted portfolio. Okay, so that's why this 24% must exactly be in the middle of those two numbers. 8% plus 40% divided by 2 must give you 24%. Okay, it makes total sense. Are you with me here?
Yes.
Okay, but that's not the case for standard deviation, okay? I didn't show you the standard deviation formula in detail, but that's not equal weighting, okay? So look at those numbers. This is 23%, this is 53%. If you add those numbers up, this is not the middle number, okay? So it has nothing to do with the middle, okay? It's very, very, very close to IBM even, okay? But anyhow, so this is what we did, okay? Just keep in mind that standard deviation is not like equal weighting the standard deviations, individual standard deviations. Okay, so let's take a look at the questions. So we have done the first one, we have done the second one, we have done calculate. We have done the third one, and then we have done the fourth one. And then yeah, so. Are there any questions up to here? Okay, I see that there's no questions. Okay, now I'm switching to the next sheet, which is very long, by the way. It takes almost an hour to finish this, but I'm just going to show you the very basics. For the rest, I will upload another video, just like you would follow that video, okay? But let's start for the very basic beginning, okay? Oh, now we have real numbers, by the way. I mean, these are from the stock market, real stock market, not made up numbers. So once again, this is realized data. Please make sure that you open the next sheet. Now we have Apple prices and Bank of America prices. And then in yellow sheets are asking you calculate the returns. Okay, so let's calculate the returns and I hit here and then Apple B7 divided by B6 minus 1. Let's calculate the returns first. I do the same thing for Bank of America. Drag and drop. Make sure that you get the same numbers. Did you? Why I already have the return in Excel. Oh, did you have the returns already?
Yeah, I had all the returns already.
Why don't you tell me, guys?
Yeah, I did too.
Oh, why don't you tell me? Because I'm waiting for you to get the numbers. Okay, so if you have the returns, fine. Do you have the returns for portfolio?
Yeah.
Okay, just delete them. And then this is not an exam, so don't worry. So just delete the portfolio returns and then follow what I do, okay? So hit here, okay, portfolio return. Okay, Apple's weight, which is given at the end, okay, just like here, it says weights should be 50-50, okay? Apple's weight, F4, just fix it, times Apple return, plus Bank of America's weight, fix it by F4 times Bank of America's return. Okay, make sure that you get the same numbers. So Wenbin, you are not the only one. Thank you for letting me know. Oh, just drag and drop up to here. So if you see those ugly numbers, and then change using those little tiny icons at the top, make sure that you have 2 decimals. Do you have the same numbers that I have?
Yes.
Okay. Now let's calculate the mean of, do you have the mean, by the way?
No, we don't have the mean.
Okay, calculate the average of Apple. Right, average, and select the Apple. Do the same thing for Bank of America, and do the same thing for your portfolio. Did you get the same numbers?
Yes.
Yes.
I'm rating some more yeses, just to make sure. Okay. A couple of other people said yes too. Okay. So let's scroll down a little bit and calculate the variance. Okay, variance is VAR, that's one. And select Apple. And I'll do the same thing for Bank of America and portfolio. And now standard, do the same thing for standard deviation, STDEV. Select Apple and drag and drop. Make sure that you get the same numbers, and then I'm going to explain you the most important takeaway of this class.
Something went wrong somewhere. I don't know what I did.
Did you get these means, exact means?
Yes.
Okay, how about variance?
I couldn't find the variance one, so
Okay,
I just skipped it.
Okay, so here's the thing. Okay, do you see what I wrote? VAR,
Yeah.
open parenthesis, D7, D18.
When I type in VAR, there's like a lot of different options, and it's not just VAR.
Just VAR. Just VAR. Open the parenthesis and write what I write. Does it work?
Hang on.
Guys, give me feedback what you get.
I have all the same numbers.
Same.
Okay, Zach is saying that. Can you click on this? Same. Okay. Hannah, are you with me?
I keep struggling with the computer.
Okay, you know what? VARP is also okay. Okay, that should be VARP. That's also okay. Just make sure that you get the same D7, D18. Okay, so here's the weird thing here, or here's the takeaway of today's class. Okay, look at the mean. So this is the mean of Apple, okay, 0.36. This is the mean of Bank of America, 0.67. And this is the mean of your portfolio, 0.52. Is it something in the middle? Just make sure, approximately at least, you can just like make sure approximately, just visually. Is it something in the middle? 50%, 50%, and more or less, right? So if you add these two numbers, okay, 36 plus 67, you get more or less this number. Is this fine? Did you get this?
Yes.
Okay, now look at the standard deviation, okay? Apple's risk, standard deviation is 8.2%. Bank of America's risk is 9.4%, and your portfolio's risk is totally out of the boundaries. It's 7 point something. Did you get that?
Yeah.
Maybe I should just use this blank space here to show you. So this is Apple, 8.2. This is Bank of America, 4.9. But your portfolio's standard deviation is somewhere here, okay? Total out of the boundaries, 7.4. So it does not necessarily be in between, okay? It is because of that formula, guys. So this formula, I mean, as I said, forget about the details of the formula, but just understand the basics, okay? This formula is basically adding two numbers, okay? So you add this number plus this number, and there's another number here. And in the middle of this number, there's something called correlation, okay? Correlation is the relationship between two investments, okay? Click in this correlation cell here, click in the correlation cell here. Let's calculate the correlation between Apple and Bank of America. And right here, Correl, okay, Correl, okay, and select Apple for the first array, comma, Bank of America for the second array. You can see what I write here. I'm going to wait a little bit. Okay, when you hit enter, you would get 0.4. Are you with me, guys? Once again.
Yes.
Okay, so bottom line is this. So the takeaway of this class is this. Let me scroll up. Okay. Okay, let me scroll up once again. Okay, so please make sure that you have to know this portfolio return formula by heart, but portfolio standard deviation, you don't need to know it by heart, just understand this thing. So there's something called correlation here. If this correlation is low, by the way, correlation is a number between -1 and +1. Okay, and then there's 0 here. So the lower, the better. So if you have a very low correlation, so you are kind of like adding these two numbers, and this, if correlation is negative, for example, you are going to subtract it. So say this is I don't know, 50. Okay. Say this is 50. Okay, it makes 100. If you take the square root of 100, it makes 10. But if there's negative correlation here, minus say 19. Okay, this number is going to make so 81. So which makes the square root of 81 makes 9 instead of 10. What I'm trying to explain you is this. There's correlation here. So we consider the correlation while we are calculating the portfolio standard deviation. So that's why portfolio standard deviation does not need to be in between those two numbers. If you have a very low correlation, the lowest correlation possible, which is -1, then the portfolio's standard deviation can be as low as 0. Okay, it is possible. So you can eliminate the risk totally. So that's the bottom line. Okay, so let me kind of summarize what we did today and then finish the class, and I will upload another video for you to review, because there are a couple of columns here that I'm asking you to understand. So maybe I open an empty sheet here to summarize the things. Okay, share my screen with you. Okay, so there are a couple of things that I want you to understand. First one, when we are considering the portfolios, let's start from the single assets. Single assets, if you buy single stock, just look at the expected return. Okay, look at the standard deviation, and you can divide those two numbers to each other, which will give you coefficient of variation. So this is enough for single asset. Okay, if you are considering a portfolio, okay, so there are a couple of things that you need to consider. Portfolio's expected return is equal to, so this is RP, is equal to first stock return times first stock's weight. Okay, or just give me a second, I'm sorry. Okay, first stock's weight times first stock's expected return plus second stock's weight, second stock's expected return. Or this is probabilistic data. If it is realized data, first weight times first mean, okay, I will write first mean, second weight times second mean, okay. So this is or, this is not divided, by the way, okay. The third thing is this. What is the variance of portfolio? Variance of portfolio is something very ugly. Don't even try to memorize it. So there's one thing here, plus there's another thing here, and there is some thing and correlation here. So portfolio's risk takes, or might take values out of the range between individual stocks standard deviation. It takes the lowest value if the correlation is -1, which means that if you invest in two stocks, try to find two stocks with the lowest correlation possible. Lowest correlation meaning if you invest in Twitter, for example, don't invest in Facebook because they're in the same industry. Okay, they are highly correlated. If you invest in Twitter, just invest in something from pharmaceuticals or I don't know, retail, whatever. Okay, so that's why you decrease the risk. Once again, let me just like try to summarize. So if you kind of invest in a portfolio, you have to take a look at the expected value of the portfolio, expected return of the portfolio, and the portfolio's risk. Portfolio's risk is the minimum when the correlation of the stocks is minimum. Okay, so that's the bottom line. As I said, I'm going to upload another video for you to kind of like grasp the idea. But other than that, this is not an easy chapter. I know if you understand like 50%, 60% of today's class, that's fine. For the rest, please rewatch the video, read the book's chapter, and make sure that you watch the other video that I'm going to upload here. Any questions up to here? Any questions?
All good here.
All good
Okay,
for me.
guys, thanks for joining this class. I'm going to, so this class is being recorded. I'm going to kind of upload the video in, probably it takes more than a couple of hours to upload it. It's going to be on Canvas. So yeah, if you have any questions, let me know. If not, we are done. Let me see the syllabus just to remind me. This week you are going to have your quiz 3. Okay, it will cover chapters 6, 7, and 8. The details are on Canvas. And yeah, we are done. Don't forget the presentations, please. So whoever is supposed to present, just like prepare a video and upload it on Canvas or YouTube, whatever. Okay, so see you soon. Bye. Oh, by the way, somebody is asking if we are going to have a live class next week. Well, next week, I'm going to ask you to watch a movie, by the way. So there's no live class unless you have a question. Okay. So there's no live class next week. Yes, we will have an end term exam the week after that, between May 4 and May 9th. Did I answer your question, Maria? Was that the question? And I'm going to upload a guideline for the final. So there will be a guideline, study guideline. What can I do if I forgot to finish PMC? Well, you can't do anything normally, but I can give you an extension for partial credit. Would that be okay? So you won't get full credit, but you can get partial credit. It's better than zero. I can extend the time 1 more week if you want to. Does this mean that you're asking it? You want it? Okay. Okay.